The markets are closed. The ticker tape has gone silent. For the first time in days, the price of silver isn't moving. It's frozen at $71.91. Most investors see the stillness and feel relief. They believe the battle is over for the week. They think they can relax, pour some eggnog, and wait for January. But the professional trader knows better. This silence is not safety. It is the calm before the most unpredictable storm of the year. We are about to enter a period known on Wall Street as Ghost Week. It is the 7 days between Christmas and New Year's Day. This is when senior risk managers, hedge fund titans, and central bankers leave the building. They go to Aspen. They go to St. Bart's. And they leave a multi-trillion-dollar financial system in the hands of algorithms and junior traders. That creates a dangerous environment, creates a liquidity vacuum. In a normal market, it takes billions of dollars to move silver by $1. During Ghost Week, it might only take a few million. In this urgent holiday update, I'm going to explain why the next 7 days could bring the most violent volatility of the entire year. I'll show you why holding $71.91 into this vacuum is both a victory and a risk. And I'll give you a survival guide for trading when the lights go out on Wall Street. The adults have left the room. The machines are in charge. Let's talk about Ghost Week. First, let's analyze the close. We finished the week at $71.91. We're up more than $1 on the day and significantly higher on the week. Technically, this is a masterpiece. We held the breakout. We didn't crash back to $65. But notice the price action in the final hours. We pulled back from the high of $72.42. Why? Because traders were squaring up. Nobody wants to be a hero on Christmas Eve. Smart money took some chips off the table, selling a little to pay for the holidays. This is normal. It's healthy. But it leaves us in a precarious position. We are hovering just below all-time highs. When you're at the top of the mountain, the air is thin. It doesn't take much of a push to send you sliding back down or to launch you higher into the stratosphere. The market is coiled. It is stored energy. And starting tomorrow morning, when the futures market reopens for a half-day session, that energy has to go somewhere. But there are no humans left to guide it. Picture a trading floor at JP Morgan or Goldman Sachs right now. Normally, it's a hive of activity. Hundreds of people shouting, phones ringing non-stop. Tomorrow morning, it will be a ghost town. Maybe 3 people will sit at desks that usually hold 50. This is the skeleton crew. Junior employees, interns, the ones who drew the short straw. They have strict instructions from their bosses. Don't take risks. Don't make big bets. Just keep the lights on until January. That sounds boring, but it's actually dangerous. Why? Because if news breaks, if a headline hits about the Middle East or a mine strike in Mexico, the skeleton crew doesn't have the authority to stabilize the market. They can't deploy capital to absorb a shock. So if a large sell order hits, the junior trader steps aside and lets the price fall. If a massive buy order hits, he steps aside and lets the price spike. The shock absorbers are gone. Market makers who normally smooth out volatility are absent. This opens the door to flash crashes and flash rallies with no fundamental reason. Silver could drop $5 in a minute and recover 5 minutes later. It's the Wild West. With humans gone, who's left? The robots. High-frequency trading algorithms don't take holidays. They don't celebrate Christmas. They run 24/7. In normal conditions, human judgment balances the machines. During Ghost Week, the algorithms are the only game in town, and they feed on volatility. If the price starts falling, the bots sense momentum and short it. That pushes prices lower, triggering more algorithms to short. Without a human saying, "This is ridiculous, the price is too low," the cascade continues until it hits a mathematical floor. The same thing happens on the upside. If silver breaks $72, the bots will chase it. They'll trigger a melt-up. We could see $75 or even $80 on almost no volume at all. This is why technical analysis during Ghost Week is unreliable. Support and resistance turn into tissue paper. The machines rip straight through them because there's no liquidity to defend the lines. And there's one more danger you need to understand: the spread. The spread is the difference between the bid and the ask. In a liquid market, that spread might be just 1 cent. During Ghost Week, the spread can explode to 20 cents, 50 cents, or even a full dollar. Why does this happen? Because the market makers step away. The few players still willing to take the other side of your trade demand a huge premium for the risk. That means if you try to trade, you get punished. Hit a market buy and you might pay 73 when the price is 72. Hit a market sell and you might get filled at 70. You lose money the moment you walk in and the moment you walk out. That is why the number one rule of Ghost Week is simple. Do not trade. Do not use leverage. Do not try to scalp. You are playing poker against a machine that can see your cards, in a casino where the dealer takes an enormous cut every hand. For the long-term investor holding physical silver, this chaos does not matter. The value of your ounce does not change just because the spread widens. But for the person glued to the screen, it is terrifying. You will see price swings that make no sense at all. You have to ignore them. The humans are gone. The robots are in control. The spreads are wide. And this creates something called a liquidity vacuum. In part 2, we are going to go deeper into this mechanism. We will study historical examples of holiday crashes and holiday rallies. We will break down the thin order book and show you visually why a small order can move the price so violently. And we will talk about the Santa Claus rally. Despite the danger, this week is statistically bullish. Why? Because when there are no sellers at the desk, prices tend to drift higher. We will look at the odds of silver touching 75 before New Year's Eve simply because gravity has been switched off. The market is empty, but the opportunity is full. It is Christmas Day. The markets are closed. Silver is frozen at 71.91. Feels calm. Feels safe. But in part 1, we explained why that feeling is an illusion. We are entering Ghost Week, the 7 days when senior traders leave and algorithms take over. We talked about the skeleton crew and the danger of automated trading. Now we need to talk about the physics of the market itself. We need to talk about liquidity. Liquidity is like ice on a frozen lake. When the ice is thick, you can drive a truck across it. You can sell $1 billion worth of silver and the price barely moves. But during Ghost Week, the ice becomes dangerously thin. Step too hard and you fall straight through. In part 2, we are going to visualize this liquidity vacuum. I will show you exactly what an empty order book looks like, and why a single buy order tomorrow morning could launch silver to 75 in seconds. We will examine the Santa Claus rally and why markets drift higher when short sellers are on vacation. And we will look at the physical freeze happening right now at coin shops. The price is high. The ice is thin. Let's see what happens when we step on it.to understand volatility. You have to look under the hood of the exchanges. You have to study the order book. Picture a ladder. On one side are buyers waiting. I will buy at 71. On the other side are sellers waiting. I will sell at 72. In a normal week, there are thousands of orders on every rung of that ladder. When a big buyer enters, they climb slowly, chewing through orders one by one. The price moves smoothly. But tomorrow, that ladder will be missing rungs. There may be a seller at 72, then nobody until 72.50, then nobody until 73. These gaps create air pockets. If a hedge fund algorithm decides to buy silver tomorrow morning, it fills contracts at 72, then instantly jumps to 72.50, then instantly jumps to 73. The price does not climb. It teleports. A gap appears on the chart because there was nobody willing to trade in between. This is the liquidity vacuum. It magnifies every move. A $10 million order, tiny in the grand scheme, can behave like a $1 billion order. It works both ways. Bad news can send the price teleporting lower. But right now, momentum is pointing up. The path of least resistance is higher. The vacuum is pulling us toward the sky. There is a statistical anomaly that appears this week, known as the Santa Claus rally. Historically, stocks and precious metals tend to rise during the final 5 trading days of the year and the first 2 days of the new year. Why does this happen? Is it magic? No. It is the absence of short sellers. Think about the mindset of a short seller. They are betting on a fall. They are fighting the trend. It is exhausting. Do they really want to fight the market on December 26th? Do they want to sit in front of a screen while everyone else has gone home? Their family isn't opening presents. No. Short sellers close their positions before Christmas. They flatten the book. And when you remove the sellers from the market, what remains? Only the buyers. Only the passive inflows from pension funds. Only the long-term holders. This creates a phenomenon called the drift. Without the heavy hand of banks pushing the price down, the market naturally floats upward, like a balloon untethered. It isn't an explosion. It is a gentle, relentless rise. 71.91, 72.10, 72.30. It just keeps going because nobody is there to hit the sell button. This drift is powerful. It can push silver through major resistance levels without any news at all. We could wake up on New Year's Eve and find silver at $75, simply because the bears went on vacation. But a warning, thin markets are fragile. While the drift is bullish, the vacuum is dangerous. Flash crashes happen during this week. Sometimes a fat finger error occurs. A trader types sell 1,000 instead of 100. In a thin market, that mistake can crash the price $2 in a second. Or a predatory algorithm senses weakness and attacks. Using leverage or having a stop-loss order. You're a target. A flash crash can dip the price, trigger your stop-loss, sell your position at the bottom, then bounce back to the highs in 5 minutes. You lose everything. The price ends up unchanged. That's why, in part 1, I told you, do not trade. Do not put stop-losses in during Ghost Week. The machines will hunt them. If you hold physical metal, a flash crash is irrelevant. It's just a glitch on a screen. But trading paper is a death sentence. Now, the physical market. We talked about dealer shutdowns before, but today, Christmas Day, the shutdown is total. I checked the websites of the 5 biggest US bullion dealers this morning. Technically open, yes, but check the pricing. Premiums have expanded again. To buy a Silver Eagle today, you're paying nearly $90. Why? Dealers fear the gap up we discussed. They know tomorrow silver could be $75. They don't want to sell at today's price, so they raise premiums to protect themselves, essentially saying, "Go away. We don't want your business until January." This confirms the shortage. In a normal market, dealers compete for your business. In a shortage, they hide. They raise prices. The real price of silver isn't $71.91. It's whatever you have to pay. And right now, that number is creeping toward triple digits. The order book is hollow. Shorts are gone. Dealers are hiding. We drift toward the new year. But what happens when the clock strikes midnight on December 31st? January arrives. And January is not a ghost week. It's a tsunami. In part 3, we'll explore the January effect. I'll explain why billions of dollars of new capital wait on the sidelines to enter the market on January 2nd. We'll examine pension fund allocations and calculate what happens when huge institutional buying hits a market thinned by the holidays. The drift is gentle, but the explosion comes next month. Right now, we float in the vacuum between Christmas and New Year's Day. Silver holds at $71.91. Trading desks are empty. Volume is low. Danger is high. But the calendar is ticking. In less than 7 days, 2025 ends, and 2026 begins. To most, it's just a date change. But to the financial system, January 1st is a reset button. Trillions of dollars sit on the sidelines, waiting for the starting gun. In part 3, we'll see why the first week of January is historically explosive for precious metals. The great rebalancing forces pension funds and hedge funds to buy the top-performing asset of the previous year. That asset? Silver. Ghost Week is calm. January is the tsunami. Let's follow the money. Think like a portfolio manager. You run a $10 billion pension fund. Mandate: balanced portfolio, 60% stocks, 40% bonds, maybe 5% commodities. In 2025, stocks were volatile. Bonds crushed by inflation. But silver? Silver went vertical. It broke $50. It broke $60. It's now $71.